everyone. My name is Catherine. I'm an investment advisor with FSMOne. So today, I'm very privileged to have two guests with us, Timothy and 𝗪𝘆𝘀𝗲. So today, we are just going to share about some of our investment experience and how to actually not make mistakes, especially if you are new to investing, or even if you are already a veteran of, as in you invested for a long time. How do you avoid pitfalls and things that you can take note along the way? Yeah, so just to start off this panel discussion with a very common questions that when it comes to investing, right? Like, what's the most misunderstood advice that you have come across? Like, did somebody share it or you heard it? Yeah.
Okay, I definitely will have a few, I think, misunderstood advice over the past few years. I'll share my own experience, at least for the most recent year. I think when we talk about companies to look at, I think a lot of time we look at the hype and then like the way that it's marketed and the potential future that it try to promise you. But I think of recent years, that is a misconception. You know that the investment methodology have changed over time with the venture capitalists, and consumers like us should also follow such a mindset. We are focusing more on the short-term ability to turn profitable or whether a company is profitable instead of the long-term hype or the dream that a certain company is trying to promise. So that for me is actually something that I feel is the most misunderstood advice in the past that I have received. How about you, Timothy?
Yeah, so I think when it comes to investing or trading, people always want to find the holy grail, right, of investing on trading, thinking that will give them all the returns they want. Right, I give an analogy. It's a bit like when people want to get fit, right? They have a lot of dieting plans, they have a lot of fitness plans, right? And then they keep trying to find the correct fitness plan that will give them all the muscle and the abs that they want. But at the end of the day, the truth is that to get the muscle and the abs that you want, it's about dieting well, it's about running regularly, it's about having a little bit of weight training consistently, right? And putting in the effort over a consistent period of time, right? Not trying to find the right program that can let you get fit easily. So I think investing is the same thing. A lot of people try to find the right program instead of being worried about the concepts that I explained just now, which is you need a diversified portfolio, you need to be consistent, you need to be disciplined, you need to have different asset classes, because those are quite boring things, right? Yeah.
Yes, I actually hear both of you. So I guess one of the common thing that we see is that there's always a one plan that fit all, but it's actually not really the case. And also, we should not actually be chasing hype, like whatever is the hottest topic right now, be it crypto or AI or what. But actually to dive into the fundamentals, like the long-term growth of the particular industry or sector, and rather than listening to hearsay, oh, my friend said. She done this and actually made quite a bit profit on it, but that's actually all taken out of context. So I think it's very important to put context back into perspective. Yeah, so leading to the second question, I just wanted to check with both of you, like if you have any investment regrets or a decision that you have made previously and you want to caution our investor about, because I'm not sure all of you came in, you all saw the wall that's outside. I think one of the top voted investment regrets that I saw on the wall was selling winners too early and chasing trends. So just want to know, Timothy and 𝗪𝘆𝘀𝗲, you all have any things to share?
Okay, he made me go first, so I'm going to go with this. I have been investing, and in fact, at some point in time, I was a professional trader for a while. And I think there are certain, at least patterns that I see over the years, which also apply to me. So number one is actually some form of biasness, where, for example, you work in a certain space, you feel that you know the space well enough, you decide to invest a lot more of your portfolio onto the stocks. So one of the investment regrets, I wouldn't say regrets, probably a bit of a mistake that I made was that because I'm super into the tech space, I thought that I knew everything, whether it's the Web3 or the AI or various tech industries. I think that I know that, and I overexpose my portfolio a little bit towards some of these companies which I have a certain biasness to. So I think the way around this is that very much like trading or investing, you need to take a step back, look at your whole portfolio as a whole, remove any biasness you have and let the numbers and some of the advice out there speak to you. because usually you're in the space, you have this very micro view on certain things. Do so consistently, zoom in and zoom out consistently on your portfolio to see whether you got yourself covered and how diversified your portfolio is, and whether there's any form of biasness that's present simply because you yourself have a certain favoritism towards certain industry or certain stocks. Yeah. How about you?
Yeah, so for me, it's not so much of a regret, but more that when I started investing, which was when we were in school more than 10 years ago, it was very difficult to get overseas investment exposure, right? So back then, to invest in the US market is more expensive, it's less accessible, and as a student, you don't have that quantum to overcome the cost inefficiency because your transaction cost is too high and you don't, a few $100s, you can't really invest much. So for me personally, when I started my investment journey, I think more than 10 years ago as a student, it was a very Singapore concentrated portfolio, which I think it's quite common for older people because the markets have evolved a lot in the last like 5 years in terms of fintech, right? But back then it was a lot more expensive and harder. So I kind of wish I had a more global portfolio from day one, but I didn't because it was just very difficult back then.
I see. Yeah, but I mean, we are happy to share that FSM have a lot of markets available right now. And I think for especially young investors who don't have a very huge lump sum to start with, we do have a dollar cost averaging, just ETF. You can start with just $50 Sing dollar a month into all the different markets. So I think markets.
Back then, I would save my whole year, then invest in one stock, one lot because you need to buy in 1,000 shares.
Yeah, correct. Yes, I guess the markets has changed so much and there's a lot of accessibility to everyone. Yeah, so anyway, just to move on to the next question, in this current day and age, there's actually a lot of media content, like be it on TikTok, Instagram, YouTube, even some of your friends shares on be it Facebook or WhatsApp. I think it's very different from the way like 10, 20 years ago when people are investing. We only look at annual reports, we attend AGMs, we look at their quarterly updates, corporate actions, and so on. So a lot of things has changed, and we are spending a lot more time on these medias instead of the original sources itself. So just wanted to see, it actually changed our consumption habits in this data that affect our perception of risk and return? Yeah.
Yeah, definitely. Jumping on this point, I'm not sure if you guys feel the same during at least some of the times where the market is doing a bit better. You see a hell lot of your friends posting on their Instagram or Facebook, showing off their returns on certain stocks and saying that, oh, I made it. When the market is down, I don't see any of this around. So I think this is something that what the technology today has allowed us to do. And it allows us a few things, right? Number one, you get information quickly, which means you tend to make slightly rash decision when it comes to your investment because you FOMO, right? You see your friend jumping on this. He's posting about his stocks portfolio, making X percentage, and you thought, hey, maybe that could have been me. I missed the train. I need to jump on this fast. And then you make all these irrational choice. But little do you know, maybe your friends are not making. They're just showing off what they have done very well. In fact, today, if you go to YouTube and all, you look at all the advertisements, it's always telling you X percentage returns, X percentage returns. Putting a lot more pressure on investors like us, thinking that, oh my God, my 5% is not good enough. But that's not true. So I think, yes, with technology, I think the good part is that now you have a lot of information available to you. This means that everything is so transparent. Numbers are transparent. Various information is transparent. Next, you can get validation very quickly. You can ask or discuss certain opinions that you have on various analysis that you have done online, and then you get a feedback pretty quickly, which means that the decision-making process can technically be shortened, and you can still make very informed decisions within a short period of time. Yeah, so I think there's definitely good and bad with regards to advancement in technology, and now, of course, with more information, you can save on your various fees because everything is so transparent. You can just go on and see which is the best platform for you accordingly. Yeah, but I think I'll just end this question here with, I think media usually tend to over-glorify various amount of returns and so on and so forth. But what you should always do is to check your own portfolio and look at the risk-free percentage. As long as you are beating it, by taking up acceptable amount of risk to you, you are fine. Don't let the media pressure get to you.
I'll just add on one thing to what 𝗪𝘆𝘀 said. What he said is correct. And I think the problem with social media, I'm just particularly saying social media, right, is that it makes us impatient, right? So, but the problem is that investing, you require patience, but social media makes us impatient, right? So I give you an example, right? So my mom-in-law cooks very good prawn mee noodles, and one of the hardest things to cook good prawn mee is the broth, right? And for those of you who cook the broth, you all will know the broth takes very long to be nice, right? It takes at least 2 to 3 hours minimally, even if you do everything right. So I was learning prawn mee from her a couple of weeks ago, and she was trying to teach me. So I was learning, and it looks easy. You just do certain stuff, you put it in the cooker, the shell, you fry the shell, you put in salt, and all these things. I have the recipe, right? And then after that, we do it already, and then she said, let it go for 2 hours, right? But you know what? Every 10 minutes, I feel the need to go and take a look. Even though there's nothing I can do to make the soup any better, in fact, I can make it worse if I try to. So I keep lowering the fire, I keep increasing the fire, I keep lowering again, because I scared it's boiling too fast, I scared it's boiling too slow. But actually, I just need to put it in there for the next 2 to 3 hours and let it go. And I think the problem with investors these days is you know what? The recipe is already there. You are already going to get a good return in the next 10 to 20 years. But you keep putting in the salt because every 10 minutes you want to try something different. And then you go from a winning position to a losing position because you don't have the patience, right? And I think that is one of the issues,
Before the next question, can I have a request for Dollars and Cents to publish the recipe online also?
Yes, you
You
should.
can come to my house, I can show you that I can do it quite well now.
Yeah, but I do agree that actually financial success is really more about the behavior than your skill itself. Because actually it's a lot of times that our behavior is impeding our success. Because a lot of times we make very short-term decisions that we will soon regret after. Yeah, so actually, when we hear of new investment ideas, what are actually some of the steps that we can take to assess, do our due diligence and so on? New investment ideas.
Okay, personally for me, I wouldn't say, I know there's a lot of information out there, a lot of investment ideas. There's no one size fit all, let's just put it that way. I won't share about what kind of investment ideas work for anyone. In fact, later I think we'll be talking about how we invest. That one I can share with you. Maybe I'll just share something simple that I do, which I learned from some of the people when they shop on Shopee. So you shop on Shopee, you put something in the cart for 1 week, right? And then after 1 week, you realize, I still want to buy this thing, right? Then you start buying. That's how you try to save a little bit or try to make sure that what you are buying is something that you really need. So it has become the same habit for me. I tried this over the past few years. I think it's very useful. Instead of being influenced by the hype and everything, I'll put a stock on a watch list for a while. If maybe 1 week later or a month later, I still feel that actually this is a stock that I really want to put some money in, that's what I will do generally. So these tiny steps work for me. I hope it works for you guys also.
I'll stay with my food analogy. So I think it's important to like what you eat before you try to cook it, right? So if you look at a new investment sector like AI this year, crypto the last few years, right? Try to understand, try to enjoy reading about it first before you think about making money from it, right? I think it's important to understand the sector very well, to enjoy eating the food very well before you try to cook it, right? And you don't need money to read all these things. You can just read, you can buy a book, go to the library, whatever, before you try to make money off it.
Yeah, yeah, very, very insightful. So just to end off this discussion today, just wanted to get both of you to share like some of your investment strategies that you have been adopting and it works for you so far.
I'll just go first. So I try not to, as you can see by now, I try not to guess the market because I don't know what will happen in the future. What I like to always advocate is that try to have different routes to success, right? So don't just think that, hey, I'm going to invest all my money into a certain robo or certain ETF or certain stock, and then if it works out, wow, I'll be very rich. I don't like that because I like to think I will be wrong. I always like to think I will be wrong. So what I prefer, because I'm 𝗂𝘃𝗁, is that I have different portfolios that is doing different things. So if some of them don't do well, which may happen, it's still okay as long as the others are performing fine, right? And I'm talking about different asset classes, not like just different stocks, different asset classes, different methodology. So I invest on my own. I also invest through a robo portfolio as well, right? So you don't have to choose one over the other.
Yeah, so I'll add on with my own point of view in terms of investment strategy. So if you look at both of us here, maybe Timothy is on a different life stage. He has a family. I'm somebody looking to maybe get married in a short term and even like get a property and so on. So the way we invest is going to be very different. If I were to adopt his methods in terms of investing, it may not work out for me, or his portfolio, it may not work out for me, right? So what I generally do, maybe I'll share my investment strategy, is that for any of you out here, if you are looking at potentially a huge outlay of expense upfront, maybe within the next few years, you might want to do this barbell strategy, which I'm on, meaning you have a sum of money which is potentially what you're going to need. For example, you're looking to get married, you need about 30K. You keep that first. Of course, you don't just leave it in the bank, right? You try to invest in something very safe, and you know that within the next 1 or 2 years, if you need the money, you can take it out with a bit of profit, risk-free profit, go on. Go and invest in your SSB, T-bills, and various stuff like that. So this will become the safer side of things. So you know barbell has two heavy ends, right? The safer side of things, go on, get your life in check, form the baseline of safety net funds. And then on the other side, right, of course, don't miss out on the market. Have a sum of money which you know you are prepared to lose. Of course, go on and invest, go crazy if you need to, but make sure that that portion of high-risk portfolio is well diversified. And you don't just take the whole entire thing and try to throw into EV or just AI. Go and diversify yourself. Form a few sectors that you feel that you have a strong judgment on. You feel that this is what I really believe in, and then you put into that. My portfolio is about 20 to 30 stocks. It's a bit too much. I will tell you first, 20 is usually a better amount, 30 is a bit too much. So I'm looking to offload some of these stocks by the next 1 to 2 years.
Okay, thank you so much for sharing all your investment insights with us. I hope you guys have taken away some very useful tips here. And I'll just pass the time back to Jane.